Hello and welcome to the Economic Update with Nordea 2022. My name is Jade and I'm the General Manager of the Finnish-British Chamber of Commerce. On behalf of us and my colleagues at the Danish-UK Association, Norwegian-British Chamber of Commerce, and the British-Icelandic Chamber of Commerce, I'd like to thank you all for joining us this afternoon. Before we begin, I'd like to mention just a few practicalities. We would like to request everybody to keep their microphones muted during the presentation. We will be recording the webinar and the recording will be uploaded on our websites afterwards. And there will be some time at the end of the webinar for questions, so please remember to leave your questions by using the chat function. And I'm sure our speaker will be happy to answer them at the end of the webinar. Without further ado, I'll give the floor to the General Manager of Nordea London, Kevin Connors.
Hello all, and it's a pleasure for us to host this event and also to introduce Kristian Nummelin, who I believe has done this presentation a couple of times in previous years. So for him, welcome back. Kristian works as an economist at the Nordea Economic Research Unit in Helsinki. He provides updates on global macroeconomic and currency market developments to Finnish corporate customers. He also closely monitors the European economy and the Brexit process. He has a master's degree in economics from the University of Turku and has worked for Nordea for almost 5 years now. So Kristian, over to you.
Thank you, Kevin, for the kind words. So as said, today I will talk about global economic outlook and how Nordics are doing, and in the end a little bit about the UK and also about the situation in Ukraine now and how it could develop and affect to the whole European economy. And I'm sure about if my eyes are popping on right and left. I have two screens, so that's why. If we move on, you can see on the left-hand side, there is our new economic outlook published just last week. The title is Heating Up. You can see it as a reference for the labor market conditions. Labor markets have tightened a lot in all Western countries, especially in the United States and also in the UK and Nordics. Also, the overall economy is doing really good. Inflation and price pressures are increasing again, especially in the United States, but also in the Europe and in the UK, and also in the emerging markets, for example, where food prices is extremely important component. And lastly, you can also see the title and the graph as a reference to the natural gas prices, which have exploded recently, and also Russia and the Ukraine situation, where tensions have clearly increased in recent weeks and months. But overall, 21 became a strong year. Global GDP is now at a higher level than before the pandemic, supported by the rollout of effective vaccines and extremely accommodative monetary and fiscal policies in all over the world. Of course, this big increase in global GDP in the growth rate comes after very challenging 2020. So in a sense, this wasn't a surprise usually, which comes first down, then rebounds. Overall, the recovery lost some steam towards the end of the year as new COVID-19 variants, such as Omicron, caused governments to implement new containment measures. Supply side has been restrained by bottleneck problems in various parts of the global value chain. Together with elevated transportation costs, increasing energy and commodity prices have also resulted as a significant global inflationary pressure. The second round effects are imminent as labor markets are extremely tight in many places and the wages have started to increase in the UK as well, but also in the Europe, and the central banks are now clearly monitoring how much the wages are increasing and should they hike rates or not, and how much they should hike rates going forward. Hawkish rhetoric from the Central Bank of the United States has caused some interest rates and volatility in equity markets. It has increased lately. Stock prices have dropped in January, and now a couple of days the stock market has been doing a little bit better, and again we are on the green. Households and companies are facing elevated costs, gas prices, electricity prices, food prices, etc. Financial markets, as said, are facing some challenges, especially from the Central Bank of the United States, where the Fed will tighten the monetary policy in the near future. Many emerging markets central banks have already hiked rates in Latin America or in Russia. And some central banks in Western countries are following, like Bank of England and Norwegian Bank have already hiked rates last year. For our economic forecast, there are some negative risks to Omicron variant and maybe even new variants, Russia-Ukraine situation, global inflation, and China's economic outlook are maybe the biggest threats to our forecast. But also there are positive risks. For example, if the China would add some stimulus more because the economy is slowing down in China, it would be helpful for the whole global economy. And if we look our forecast on the right-hand side, there are some interesting points to note. For example, Nordic countries are strong, and they have been strong through pandemic. There are some factors on the background why Nordic countries have been doing so well. Different approaches to use of containment measures. Like in Sweden, the restriction where at first there was clearly less restriction in Sweden than in other countries, but an overall trust in authorities has helped the Nordic countries. Also, solid public finances and generous compensation schemes for the companies and employees. Of course, as a result, the public debt has increased. Well-functioning healthcare system has been benefiting also the economy, and large public sector as an automatic stabilizer has been helpful too. Second thing to note is that the Chinese growth rate is expected to be clearly smaller than last year or years before. The main reason comes from the regulation, which is now stricter than before. Especially in the property market and real estate sector. Of course, China knows that when they increase regulation, it will have effects for the economy. So this is not a surprise for the Communist Party. The leaders of China has decided that the old growth model is maybe a little bit too risky going forward, and that's why they have decided to increase regulation, so there won't be any asset bubbles or something like that. China is they have a great ability to learn about the mistakes that other countries have done. For example, we all remember that the financial crisis, and before that the housing market was red hot in the United States. Now this is something that China is trying to avoid already now. So they will increase regulation before the problem is too big to handle. If we move on, and unfortunately we still have to talk about the virus a little bit. I follow the financial markets on a daily basis. It seems that the COVID-19 situation isn't that important anymore for the financial markets, but it will have an effect on the real economy in the short term. The good thing is that the Omicron looks to be somewhat milder than other variants like Delta variant. But Omicron may create challenges on the supply side. If people are getting sick, it means that there are not anymore workers to do the industrial jobs. So they may have to close some factories, at least on a temporary basis. We assume that the Omicron creates only small and short challenges for the economy. And it seems that the reactions are milder than a year ago. On the left-hand side, we see the Google data about the mobility of people. And we can clearly see that in big four countries in Europe, the reaction has been quite mild. Of course, there has been new restrictions and people doesn't move that much than before December, but still the negative growth rates are not that bad as 2020, for example. And this is possible. For example, in Denmark, the cases are all-time high, but they are still deciding to remove the restrictions. And the background is that because of the intensive care is much smaller than the actual COVID case numbers would indicate, that creates some room to remove the restrictions. Also, thanks to the vaccination, it's really helpful that in Western countries the vaccination rates are quite high. Although this creates problem for the emerging markets where the vaccination rates are smaller. It could be that in some place where the vaccination rate is smaller, there would be a new variant as seen in Omicron. So virus still can create some problems and surprise us again. If we look how the restrictions are in different countries, in the Nordic economies, it seems that through the pandemic, the restrictions have been somewhat milder than other countries. This data is from the Oxford University, and when the number is higher, then there is more restrictions. Of course, I'm not exactly sure that the data is the best quality, because in at least what I follow, it seems that the UK would have slightly less restrictions that the graph indicates. But overall, we have seen that the restrictions have somewhat increased due to Omicron, but overall the level is much milder than in 2020 in both graphs on the left and right hand side. And if we move on the economic outlook, I think the left-hand side graph pretty good illustrates what have happened. At first, a big drop, and then huge increase in GDP levels. And overall, it was hard to see this happening in 2020 when the pandemic hit us. Pretty much every country in Western economies is on or even above the levels on GDP terms that we saw in pre-pandemic levels. And of course, there is a huge gap, for example, in Eurozone. Spain is still not above the levels, pre-pandemic levels, but in the Nordic countries, pretty much every country is above the levels. And China is, of course, a different animal also in this sense. The drop was much smaller, and then again the GDP increase was much faster than in Western countries. Maybe the most important thing to note what pandemic has done is the consumption, how consumers have been consuming different goods. When the pandemic hit us, of course, the consumption dropped and there was a lot of uncertainty. But since the initial COVID-19 panic, we have been consuming quite much goods and not that much services. Services are still clearly below the trend, long-term trend. The data is from the United States, but this is pretty much the situation in all countries. Of course, it's hard to consume services when restaurants are closed or you are afraid to go to the shopping. And now we have been consuming goods, and that's huge demand shock for the economy. And on top of that, no one expected this to happen. It takes time to build factories or even hire more people. So this has created some problems and bottlenecks on the supply side. The supply side problems are the biggest one in the United States. Of course, the stimulus checks, what have been sent through pandemic in the US, has been one driver behind this, but also there are problems in the Eurozone. On the left-hand side, we can see the PMI index, which means that if we are under 50 level, the delivery times are increasing on month-to-month basis. It seems that in last couple of months, the situation has been slightly improving, but again, the Omicron variant could create some additional challenges to supply chains. If we look how the world is doing, and we can see that if we exclude Euro area and the United States, then the world is doing much better. So this is especially focused on United States, UK, and the Eurozone. So basically a Western countries problem, not as big problem in China or emerging countries. Then companies struggle to find employees currently. There is a couple of indicators, one from the United States and one from the Eurozone. We can see that the companies are reporting that they are really hard to find employees. And this means when you can't find the employees, the wages starts to rise. And this means inflation is coming. And also this kind of a global situation. When I talk to companies in Finland who operate in Finland or abroad, there are usually three main themes that the companies are struggling with. One is finding employees, rising costs, and then supply chain problems. For example, if you are an IT company, maybe you don't face that many costs because you don't buy that many goods to produce your service, but you will struggle to find employees. And on the left-hand side, we can see that this has created challenges, and the inflation is on the highest level in maybe 30-40 years, especially in the United States. In my graph, there is a core inflation, which means that the inflation excluding energy and the food prices. It's usually a better indicator for the broader inflation pressures because the commodity prices usually do not rise year after year. And as we can see, the central bank's inflation target is 2% in Western countries, and inflation is way above that level. It means that the monetary policy will be tightened in the coming months and maybe years. And in unemployment rate in the US, Euro area, and also in the UK, the labor market is really tight at the moment. And usually when you struggle to find employees, as said, you have to pay more, and when you pay more, it leads to rising prices. And in Eurozone especially, we have been struggling to get inflation to the target. So when the inflation is 2%, it actually means that the economy is more healthy than if the inflation is 1%. So it is not a bad thing. If we look the short-term situation in economy, maybe one of the best indicators is the global PMI on the right-hand side. We can clearly see that the composite index has been dropping, services and manufacturing index has been dropping, but we are still way above the 50 index levels. So activity is increasing on month-over-month basis, but the fastest acceleration is already behind us. And it makes sense because we have seen the big drop in the GDP due to the COVID-19, and then again we are now already back to pre-pandemic levels, and now economy is slowly but surely moving towards the normal growth rates. World trade picked up in November. It could be an early indicator that the supply chain problems are somewhat improving, but again the new virus situation could dampen this, and meaning the supply chain pressure will increase again in this and maybe next month. It will take some time to supply chains to go pre-pandemic levels, and it's not only 2-month thing. Usually this could take like 2 years to fix whole for example the car industry and the shortages that the car industry is facing. If you look Nordic countries, economies are strong, households are rich, and on the left hand side we can see, for example, retail sales, they have increased a lot. And please note, you shouldn't compare the countries with the different countries. Maybe their own history is better comparison group because of the statistical differences between the countries. On the right hand side we can see exports. Many Nordic countries face the same problem, that the demand is much higher than you can actually supply because of the supply side problems. And again you have been struggling to find employees. So demand is there, but it's much harder to produce the goods. And so demand is dominating currently. And here we can see on a Nordic level, this is our Nordea's credit and debit card data. We track how our customers use credit cards or debit cards, and we can see clearly also in here that people are buying much more goods and services. The consumption has moved from the services to the goods, and there are many sectors still in the economy. The whole economy is doing good, but many sectors are still struggling. For example, taxis or public transportation or culture or anything that is related to the service sector. They are really struggling, although the overall economy is doing well. And here we can see the employment changes, just to show you that how has the employment developed in all Nordic countries, and especially Sweden and Denmark are doing really well. So and it makes sense that you are struggling to find employees when the employment has increased that much. Also, the inflation has risen in all Nordic countries, so the global inflation is really there. I think the one of the interesting things to watch this year and also 23 is the central banks. The monetary policy has been really loose in recent years due to pandemic, and it has boosted the asset prices. Pretty much every asset price has increased, house prices and equity prices. And now central banks are facing a kind of a dilemma. they have to tighten the monetary policy already this year in many countries, maybe not in the Eurozone, but for example in the UK and Norway and United States. At the same time, usually the rising interest rates create some volatility for the equity markets. And we have seen this lately, starting this year. The equity prices have been dropping a couple of last days. It has been better risk sentiment, but still equity market is kind of struggling with the higher interest rates. But usually, if we look what has happened in the history, it doesn't matter if the central bank starts to tighten the monetary policy. Usually stocks keeps rising, but of course the angle isn't that tight anymore. Usually the stock market doesn't rise 20% every year. The long-term average is around the 6%, so it makes sense that when you have big rises, then you have also a little bit decreases, and on average you are assuming about the 6% growth rate. But this is especially interesting to what's in the short term. And usually, if we look what sectors are doing, the IT sectors are usually the hardest to hit when the rates are starting to rise. And just to note about the central banks, we expect from the US, the Federal Reserve, to hike 4 times rates this year and 4 times next year. In the Eurozone, we do not expect the rate hikes this year, but they may hike already in early 23. Also, we expect that they will only hike in late 23. Central banks have many tools to tighten the monetary policy. Currently, the reasoning is that they have been doing quantitative easing, so buying public sector bonds. First, they start to buy less bonds. Then they will stop buying bonds. Of course, they will still reinvest the principals from the bonds. But when they are in net terms buying anymore, they will hike rates. And when they have hiked rates maybe couple of times, then they will start to actually do quantitative tightening, meaning that when they get money from the maturing bonds, they will not reinvest the whole money anymore. This has been something that the central banks haven't really done in a global scale, and this could be interesting story to watch in 23. What will happen when central banks will start to do quantitative tightening at the larger scale. And then just a couple of notes about the Russian economy, about the Ukraine situation. From the economic point of view, Russia is doing well. The GDP dropped about 3% in 2020, and last year it rose just over 4%. This year the economy is expected to grow about 2.5%. On the left-hand side, we can see probably the biggest problems for the Russian economy. The investment rate is way too low. Russia is currently at the same level than high-income countries, where so-called easy investments are already made, and potential investments are harder to find. One can't just go by what other has done. However, Russia's comparison group should not be high-income countries. The right comparison group for Russia is an upper middle income group. And if we look in the history, usually countries which have grown fast have been investing about 30% of the GDP, for example, Baltics and Turkey and Asian countries. And the big problem is that when institutions are weak, such as in Russia, there is no appetite to do investments. Russia faces a couple of other challenges too. Long-term growth outlook is quite weak. If we look labor productivity, it has been rather average, not faster than in more advanced economies. And if we look, for example, education statistics or investments in research and development, it seems that the current situation won't change in the coming years. All in all, the potential GDP growth rate, so the long-term growth rate of the economy is maybe about 1 to 2%, is a pretty good estimate, which is pretty low for emerging economy. And on the right-hand side, you can see that Russia is still very dependent on oil and gas, and heavy dependent on fossil fuels do not go well with the trend to move away from the fossil fuels. If we look what has happened lately about the Russia and Ukraine situation, if we look the market reactions, we see that the risk premium has clearly increased, but there is not full-blown panic yet, and actually the risk sentiment has improved in this week, especially also late last week. I have a couple of kind of scenarios on the right-hand side. The first one is de-escalation, meaning Russia and Western countries would make at least a temporary deal. The problem is that this may be quite hard to achieve. Tensions are so high that President Putin has to have some kind of victory, so he would not lose his credibility in Russia. On the other hand, Russia's demands for the NATO are too big, and NATO will not agree to limit its expansion to the east, for example. The second scenario is maybe the most probable one. Russia has communicated that it may do some military technical operations if the result of talks is disappointing. The operation could be wide-ranging. We could see Russia to move some missiles or nuclear bombs closer to the west. There is also a possibility Russia to do a military deployment to Cuba or Venezuela even. This would raise tensions even higher. Another option is to use method from the hybrid war towards the Ukraine. The key thing towards from the market perspective is how West would react to the escalation. I think this is the most possible scenario, but again, it could be a wide range what can happen under this scenario. The last one would be the biggest shock for the markets. Russia could start a full-blown war in Ukraine. This is something that I do not expect to happen, but we cannot rule it out. In this scenario, everything is possible, and West may use even the tightest sanctions. And about the sanctions, there are a couple of points. The SWIFT sanctions, they would be the toughest one that Russia could face. I don't expect those to happen. Usually, the SWIFT sanction would hit the average Russian consumer. So sanctioning Russian banks and export controls are much more likely if there is a need for tighter sanctions. I do not expect this to be a market driver for the broader market or the broader economic outlook. Usually it could create some volatility in the short term, but this won't be a long-term driver. Of course, if there is an open war, it's a negative for the risk sentiment, and it could create some challenges if Russia would turn off the gas pipes. It would create more inflation and mean that the real income would take a hit, and the consumer spending would decline, at least temporarily. But again, these changes are probably going to be quite small. And lastly, just a couple of points about the UK. of course, we know that the Brexit creates some problems. Overall, UK economy is doing quite well. Of course, the inflation has risen, and Bank of England has already hiked rates. We expect 2 more hikes this year. Probably we are going to see already on Thursday the first one. Brexit has created some challenges. On the right-hand side, we can see the investments, and after the Brexit referendum, the UK investments have been slowly but surely declining, or at least the growth rate has been declining. And for example, in the Eurozone, there is a small positive trend after the Brexit referendum. It's quite hard to estimate what is because of the pandemic and what's the reason or driver behind the foreign trade numbers. But I have read a couple of articles about this, and it seems that the Brexit has hurt also foreign trade because of there is more trade barriers now. And of course, uncertainty regarding the Article 16 creates some more problems for the companies, at least those companies who are trying to decide should they make a new investment to the UK, for example, to the France. I think I have used my time at this point, and now we are ready to move to the questions. And here is also my contact details. So if you have any question in your mind later on, you can send me an email. Happy to answer those too.
Thank you, Kristian. So yeah, let's move on to the questions. For everybody who may have missed the first couple of minutes, if you have any questions, just leave them on the chat function, or you can alternatively raise a hand and wait for your turn to ask your questions directly from Kristian during the Q&A session. So we do have a couple of questions here. The first question is, looking at the figures of the enormous growth in house prices since 2019, does Kristian think there is a danger of banks getting themselves back into the mess they got themselves into in 2006 to 2008 through overexposing themselves to real estate-backed instruments? We have already seen in the UK banks again offering loans of nearly 100% of the house value. So what do you think?
Of course, there are risks when the conditions are like we are facing right now. But overall, the regulation is much stricter in every country compared to the before the financial crisis. And the balance sheets of the banks are in much better condition. So the risk isn't that big anymore. And for example, if the banks would be in a bad shape, we would have seen a much bigger impact when the COVID-19 started. I think it proves that the banks can handle these current risks quite well.
Okay, thank you. Then the next question is, what is Russia's domestic consumption value in GDP vis-a-vis export share of GDP?
That's a good question, even though I don't really have a straight answer to you. That's something that I should have to look on more, because I don't have the right number in front of me and can't remember it. So I think I won't guess this one.
Okay, thank you. So are public sector debt levels dangerously high, particularly in Finland? What do you think?
Yes and no. In a short term, no. That's also in every Nordic country or even the United States. The debt levels do not worry us in the short term. The issue that especially Finland is facing as the people and population is getting older, and it creates some pressures for in 20 years time frame. And we should have some kind of a plan how we would get some surplus years in budget wise. So the challenge is a long-term one, but not in a short term. And we can see that if we would face another pandemic again in like 5 years, then we would not able to stimulate the economy at the same scale that we did in 2020. So it creates risks when you don't have the fiscal capacity that much to use.
Okay, thank you. So next question is, do you have any figures for the impact on trade between Finland and other Nordic countries since Brexit?
Yes and no. Yes, I don't have those in that presentation. I can maybe if you send me an email, I can create some figures for that. But the problem is that it's really hard to say what's because of the Brexit and what's because of the pandemic. For example, when the pandemic hit us, we started to consume much more goods than services, meaning that we are buying much more goods from the China. And at the same time, we have the Brexit, and it is really hard to find which one is dominating, at least in the short term. I think it takes at least a couple of years to have a better understanding how much the Brexit process has been impacted the trade.
Okay, yeah, I think you kind of answered to this one just there, because Jana was asking, according to Statistics Finland, trade between Finland and the UK has been impacted more by the pandemic than Brexit. So do you agree with that statement as well?
Yeah, I think the pandemic is the biggest reason. Of course, when we look specific components, for example, food trade or something like that, then we can quite well see that it's driven because of the Brexit is the main reason behind that. But overall levels, it's much harder to say which one is dominating.
Okay, thank you. The next question is, do you see the recent drop in global equity prices as the beginning of a longer-term BEAR market or just a correction?
I do see as a correction. I don't know. Usually when we have a bear market, it means that the central banks have already tightened the policy, and at the same time the economy is facing increased recession risks or even a recession usually. So those conditions are not met. So I think this is a technical correction in that sense. Of course, it does mean that the equity prices could drop like 10% or even more in the short term, but I don't think this is a bear market that would last like a year or so. And maybe one point regarding the equity prices, when we look at the index levels, those has dropped like 10% or something like that. But there are, when you look through behind the index levels, there are many companies that have lost 50-70% of the value, especially in the IT sector. So it's really different between the different companies.
Okay, thank you. Is there any other questions in the audience? Anybody want to raise a hand and ask directly? Or do you have anything else you wanted to mention, Kristian?
I think that's pretty much all from my side.
Okay. Well, in case there's no other questions, I wanted to say thank you from myself, from the Finnish-British Chamber of Commerce, from the Norwegian and British Icelandic Chambers of Commerce, and the Danish-UK Association as well. Thank you very much, Kristian, for your presentation, and We will be sending the Nordea Economic Outlook to everybody along with any other materials Kristian may send us after this webinar. In case there's no other questions, I think that's all from our side as well.
Thank you.
Thank you very much, and have a good rest of the afternoon, everyone.